Hey, everybody, welcome to Flip Your Life, where we talk about how investing in real estate is a way not only to make money, but to transform your entire lifestyle. I'm your host, Michael Haberman. Over our first year of podcast, we've spoken to several investors who have shared their stories, how they got into investing, what their journey has looked like, and the many ways investing has changed their lives. Our guests have told us how investing in real estate has enabled them to leave their full-time jobs, spend more time with their children, or more time traveling. In essence, take control of their schedules and decide how they want to spend their time. We've had great feedback from our listeners, and they've told us that stories have inspired them. But some are yearning for some more education on how they can become an investor or how they can deepen their investing. So as we head into the new year, we're going to mix things up a bit. We'll continue to share the stories of investors, but we're also going to sprinkle in some educational episodes to help teach investors how they can flip their life. We're going to start with one of the most basic parts of investing, but one that many people don't really understand, the appraisal. Most people know it's a document that says how much a property is worth, but they don't understand everything that goes into an appraisal. So today we're going to dig into the nuts and bolts of appraisals with John Copulos of Copulos and Associates. John has been an appraiser for 40 years and is the host of the Facebook group Ask the Appraiser, which has more than 80,000 members. He also happens to be one of Rocky's Funding's preferred appraisers. So John, it's great to have you here and welcome.
Thank you, Michael. It's great to see you, and I'm excited to share some of my wisdom over those 40 years with your investors and your audience.
Great. So let's just start with a very basic question. Explain to our guests, our listeners, what is an appraisal and also what is an appraisal not?
Well, so an appraisal is not a home inspection. An appraiser does not have the ability to tell you what needs to be fixed behind the walls, the plumbing, the electrical, that type of thing. We can see the basics. We can see a roof falling in, but as far as a home inspector, that is not what we do. What we do, Mike, is we are the eyes and ears for the lender. And in your case, for your investor's case, it would be you, a hard money lender. We go out to the property, we measure the home, we take pictures so you can see everything. We report to you what the neighborhood is all about and what's happening in the neighborhood. And then we take a deep dive into the home itself. How many bedrooms is it? How old is it? What's the size? Is the basement finished? And then we go out and we compare that to other homes that we deem to be comparable. So with the eyes and the ears, as I said, for the bank, and we put a value on the home as it sits, and then also what your investor is planning to do with the home. We put in a as repaired value on the home for you to figure out how you're going to lend.
So we're going to come back to after repair value. But one thing you said that I think is interesting, you said you're there for the lender. But one of the ways we think about it, because of being a family-owned business and the way we think about our clients, we always think the appraisal is good for our clients as well, right? 95% of the time, our clients know what they're doing. But there's times where they get the appraisal and they say, maybe this isn't as good a deal as I thought. Maybe I should try and get out of this deal.
No doubt about it, Michael. I think an appraisal is key in the transaction circle. So like you say, we are there for you guys to make sure that your investment is wise in your flipper. But in reality, we're going to let the flipper know if they're making a good deal also. Yeah. We can feel comfortable with that.
Great. So you mentioned what you do is then you compare it to other houses. So I think this is the most controversial thing for investors. Tell us about how an appraiser goes out and selects a comp. I think sometimes people think, he just didn't like me. He decided to pick this, this comp. But there's a science to how you pick a comp. So walk us through that a little bit.
Well, you say a couple of things that make me chuckle. First of all, it's important that an appraiser like the investor. And, because we're human, right? So if you're an asshole to the appraiser, you keep the appraiser waiting 20 minutes, you don't give a call, you talk to the appraiser like he's, like you're his boss, you could have some issues. So we are human. I wanted to say that. So you always want to be professional with an appraiser because it's an important part of the transaction. So you gotta be good to the appraiser. But
Yeah.
when you talk about what we do and how we look at comparables, the most important thing, Michael, is the neighborhood, right? So school district is most important to us. I mean, you do your lending here on the Northeast and you do it all over, but I appraise over here in New York. So school district is king. Almost always on every appraisal that I've ever done, I've always stayed within the school district. So that's the first thing. Then you're looking at size, Michael. I want to take a look at the size of the house. I want to make sure that I'm comparing apples to apples. I'm not going to compare a 1,500 square foot ranch to a 3,300 square foot Victorian just because it's one block away from the subject. Okay, so take a look at size, take a look at location. Then we're going to talk about bathrooms. Bathrooms is key in a house. Whether a house has one bathroom or three bathrooms makes a big difference to what type of buyer, the buyer pool that's going to be looking at that house. So I'm not going to compare a one-bedroom house to a house that has 2.5 baths. It's not right. If I have to, I will, and then I'll make big adjustments for those additional amenities, or a house with a pool, or a house with a basement versus unfinished. So it's school, it's size, it's style, right? If I'm looking at a colonial style home that has the living room, dining room, kitchen, and a family room on the first floor, those are your living quarters. Call that your living quarters. Then you go upstairs to your sleeping quarters. It's a little bit of a different layout than a ranch would be, where the sleeping quarters and the living quarters are on the same floor. So I'm going to try to stay away from doing that also. That also isn't as comparable. A typical buyer might only be looking for ranches or for colonial style. So I don't want to use a ranch style home if I'm looking at a colonial style house. So these are the type of things that go into play.
Great. So then I'm going to ask you, what about when it's sold, right? So what's more important, a house that's very similar to the house you're looking at, or a house that's sold more recently? And I think there's some guidelines, right? Like if it's sold 2 years ago, you can't use it, I assume, right? But so how does that factor in?
So Mike, I just did an appraisal actually where I had 5 comparable sales on there. One sale took place 3 months ago. The other 4 are a year and 2 ago. So if you can explain why you're doing something in a logical manner, the lender will usually understand and agree with your assessment to use these older sales. In my opinion, it's always best to go further back in time to find that great comparable. So if I have a unique home and I can't really find something that's sold within the past 6 months or a year, which, as you say, is the preferred time limit, right? Lenders want an appraisal to have comparables that are within 1 year at least. They'd love it to be 2 months old or 3 months old, and I'll get back to that later. But if I have a unique property, or if you're looking to buy a unique property, you can go back a year, 2 years, 3 years, and just make an adjustment over that time period. So let's say we're in Scarsdale, and 3 years ago, everybody knows, and you do some research, and it looks like values have gone up 15% over those 3 years. And I'm going to look at something for $1 million 3 years ago. I'm going to be able to add on 15% or $200,000, whatever that might be, and let the lender know, hey, listen, it's sold for $1 million, but I'm adding on another $225,000 for the time adjustment. So the fact that Mike's borrower is looking for a house at 1.2 still looks good with that $1 million sale.
Okay. So for
going
you,
back in time is key.
So for you, when you're appraising, your preference is to see a house that is as comparable to the house you're appraising. That's what you put above everything else. Similar style, colonial versus colonial, 3 bathrooms versus 3 bathrooms, 4 bedrooms versus 4 bedrooms, same school district, as you said. And then if you can't find that, that's where adjustments come in, where you have to find a house that's not exactly the same, and then you make adjustments. So explain adjustments just, briefly.
So sure. So as an appraiser, we have to look at the data and see what the data is telling us. as an investor, you may not want to have to dive in that deeply, or as an agent, obviously you don't have the same background as an appraiser, so it's you don't have to analyze the data as much as an appraiser might. But what I like to talk about is, let's take that 1990 colonial that has eight rooms, 4 bedrooms, and 2.5 baths, and they were built in the 90s. And the same builder built a bunch of homes. One of the homes has a finished basement. One of the homes doesn't have a finished basement. You're going to line those two houses up, and you're going to ask yourself, what do I think the typical buyer in this market pool that's looking for this type of house is going to pay for that finished basement versus an unfinished basement? And that's what you as the investor are going to do. And as an appraiser, I'm going to go out and look and find, over the past couple of months or years, sales of unfinished homes, unfinished basements versus finished basements, and see what I find to be the difference. Many times those numbers are going to be fairly close. So if the market is telling you that a buyer is going to want that finished basement for that extra space, for that sleeping area, for that living area, whatever it might be down there, and they're willing to pay $100,000 for it, and that's what the adjustment's going to be. Now, if I go in there and I analyze the data and I see it's only worth $75,000, I'm going to make a $75,000 adjustment for that. But you are in the ballpark at 100. You're not too far off. So it helps you to understand how the market reacts to these different amenities.
Yeah. And what are the most common adjustments? Like a house has one less bathroom, so you might adjust for that. Has a garage versus not a garage. Those are the ones I see most often, right? And then finished basement versus not finished basement.
Yeah. So obviously, the size of the land. Okay, if there's a big difference in size of the land, that's going to get an adjustment. The overall age of the home is going to get an adjustment if there is a huge difference. Now, again, if you're doing the appraisal right, there shouldn't be a big difference, so you don't have to worry about that. Condition is key, right? If the house hasn't been touched in 40 years versus one of your homes that you're going to come in and do a complete gut renovation, is going to be a huge adjustment for that. Bathrooms are key. Bedrooms, Michael, bedrooms aren't as key as you might think, because as an appraiser, we kind of look at size. So if there's a 2,500 square foot 3-bedroom versus a 2,500 square foot 4-bedroom, there's not much of a difference. In actuality, the 4-bedroom is going to have smaller rooms. So the 3-bedroom house might be a little bit more appealing to people. So we don't pay too much attention to that, to bedrooms. Now, if I'm looking at a 900 square foot two-bedroom home, and then I have a 3-bedroom 1,500 square footer, I'm gonna adjust heavily for that difference in bedroom and size. So that's where that comes into. But between 3 and 5, not much of a difference. It's really about size. And then we talk about the basement, whether that's finished, and then do we have a 3-car garage? Do we have a 1-car garage? Do we not have a garage? There's an adjustment for that. Then the last thing is we look at the different amenities on a property. Is there a barn? Is there a pool? Is there a she shed? Is there, those type of things. And we go out into the market and we see what those things are worth in the market.
Got it. Okay, good stuff. So we talked about after repair value appraisals. And for those of you who are newer investors, that means you're going to buy a house, you're going to renovate it, and like a lender like us is going to look at what that property is going to be worth after it's renovated. So tell us a little bit about how you do that. It seems like, well, I don't know, how do you know, right? So tell us a little bit about how you come up with an after repair value.
Well, there's a lot of moving parts to that question. First of all, you as the lender want to have a great appraiser that you use to tell you what these homes are worth. You want to kind of stay away from an appraiser who might have little experience or no experience in the area. You don't want to hire an appraiser from Long Island to take the 2-hour drive up to Brewster to do an appraisal for you. You want to find a local guy. So that's really important for you as the lender, and for you investors. I got to tell you, you really should have an appraiser in your toolbox to help you. Make sure the appraiser wants to help. They're patient, they're kind to you, and they know their stuff. So it's very important to do that. What What was your question, Michael? I
How
forget
do you
what
come
you
up with
asked
an
me.
after repair value?
The ARV. So
Yeah.
obviously it has to do with the scope of work that's supplied to the lender and to the appraiser. We get a copy of that scope of work and we get to see. So I'm going to take a walk through the house and I'm going to see, okay, they're putting in new windows. They're going to put in new kitchen, new baths, hardwood floors. Do the numbers make sense? Are they in a $1 million home that they want to sell for 2.5 million? And are they giving me a scope of work that has a $10,000 kitchen update, or are they giving me a scope of work that has a $100,000 kitchen update? That type of thing. So it's and one of the reasons why I was talking about experience is because over the years I've developed the knowledge to see what the market is requiring and whether that scope of work is true to what the market wants and that typical buyer wants. You've heard that old saying, Mike, put lipstick on a pig, right? So we have to be careful with that. And you as a lender also have to be careful with that.
Yeah, which is important. And again, like, we like to use local appraisers, as you said, different markets, even in just the Hudson Valley. In certain areas, $15,000 kitchen's okay for the value you're going to get. In other areas, like in Scarsdale, in a $2 million house, you better put in that top of the line Viking kitchen, and so you want to make sure you know that. That scope of work is really important. Let's just talk quickly about the investor. You touched on this in the beginning, but tell us a little bit about the role of an investor in the appraisal. You just mentioned the importance of the scope of work, but let me just ask you quickly. Do you like to have the investor there at the inspection?
Yeah, so Michael, you're gonna, this is a personal opinion, and it's my opinion that I definitely want the investor there to walk me through the property and give me a vision of what they see, so that I can make sure the scope of work rhymes with that vision, and I can also make sure that the what they're doing makes sense to the area. Now, the investors that you deal with are very, very savvy. So many times they understand this, but you'll be surprised. And I may be going out of my lane when I do it, but if I have a good rapport with that lender, I'll suggest different things that I think they should do also, right?
Yeah.
I've made suggestions for bigger closet space. I've made suggestions for circular driveways. I've made suggestions to do something different with a flex room. So these are things that an appraiser can do for that investor. So I always like to have the investor with me so that I can get a real feel for what they want to do with their investment.
What about investors sending you their own comps in advance? Do you like that?
Yeah, again, it's more information for me to analyze. It's more data for me to take a look at and see if it makes sense. If the data or the comparables that the agent or you, Michael, the lender, or the investor sends me, I'm going to look at it all. And if it's good stuff, it'll just what's the word, it'll open up my mind to the investor having a sharp and savvy view of the situation.
And what's the proper way to challenge an appraisal? Sometimes investors want to challenge, which I know personally. That's fine. You're not perfect. But what's the proper way for an investor to say, hey, I think your value's off. Here's why.
So again, it goes back to being a professional in a professional manner. No appraiser wants to see a letter from somebody saying that the appraiser sucked and he didn't know what they were doing, this and that. It's got to be factually based, not emotionally based. It's got to say, hey, we saw the appraiser looked at XYZ Main Street, but we noticed that we thought there was a good comparable on Smith Road. Can he take a look at that? Is it possible for him to review it? We reached out to the agent, and the MLS said it had 3.5 baths, but it has one bathroom in the basement, so it's really a 2.5 bath house with a finished basement and a bathroom down there. Or we reached out to the agent, and the appraiser called comp number one a 4-bath house, but the bathroom was in the she shed, so it's really 3 bathrooms, and it's that type of thing. So if the information given is correct, logical, and very professional, any appraiser should look to do that. Now, Michael, with that said, there's a lot of appraisers who think their shit doesn't stink and they don't want to review information from anybody else. So you just got to be really careful. Just like there are good plumbers and good doctors and bad attorneys and good attorneys, you're going to find appraisers who walk the same path. There are good ones and there are not so good ones.
Let's talk quickly about rental properties. So in these new DSCR loans that we're doing a lot of, which are a great product, they're based on cash flow. So a key component is the rent. And what we often see is the tenant shows us that they're collecting, say, $2,000 a month in rent, but you have to find the market rent. And sometimes, even though they're collecting $2,000, the market rent is only, say, $1,800. So just tell us quickly a little bit, how do you find market rent? And I know, not to answer the question, but this can be a little bit harder, right? Because typically if a house is sold, it's been on MLS. But if a property's been rented, it's not always on MLS. And sometimes that's why you come in lower, I think, than what they think the rent would be. So just tell us quickly about the difficulties and how you go about finding market rent.
Yeah, so it goes both ways, Michael. You talked about the rent that's going for $2,000, and I can only support $1,800. That's from the research that I did in the area, and many areas, especially where we are, Michael, they have the MLS really has good information for rental values. But it's the other way around. Also, you can always consider, hey, this landlord had this tenant in the house for 8 years, and they're collecting $1,600 rent. But my job is not to support what the tenant is paying. My job is to show the lender or the investor what they can actually get for the rental. So in that case, I might show a much higher value. I might show a $2,200 value for a comparable apartment. You also have to look at as is versus ARV. What's a renovated 2-bedroom unit going to rent for? And I can't look at it in the condition that it's in now. I gotta imagine it, what it's going to be like when it's done. So then I'm going to go into the MLS and I'm going to look for properties or rentals, just as I do for comparables, that have similar amenities to it, similar characteristics to it, and I'm going to come up with a value. If there's a half a bath difference, there'll be an adjustment made for monthly rent. If there is, if one of the apartments is 150 square foot difference, there might be a little bit of an adjustment there for size. If one of the apartments uses the basement, there might be an adjustment for that. So again, it's very similar to the comparables. And in our area where the MLS is great, we get our information from the MLS.
You do get to, okay, great, good. Well, John, this has been really informative. I think our guests have learned a lot, but this is Flip Your Life. So I do have to ask you one question about that. So you didn't really flip your life because you've been doing this for 40 years, but you're a business owner. And so similar to investors, right, you have a lot of control over how you spend your time, which is the goal for many investors. So tell us a little bit about that, how that's played out for years. I know you have a lot of friends in banking, traditional W-2 jobs, you have a lot of friends on Wall Street. Tell us a little bit about the value of owning your own business, which is what so many investors are looking to do.
Well, I'll tell you, Michael, and you hit on it in the beginning. One of the reasons why I love what I do, it's my first and only gig right out of college. I was hired by a bank, an appraisal department at a bank. I was there for 10 years and then I went on my own. So the reason why I love what I do is that it gave me the opportunity to raise my kids. 40 years ago, it wasn't vogue for a father to be on a school bus taking his kids to Bronx Zoo with 20 other mothers on the bus. But I did it and I love doing it. I was coaching my kids. I'd be able to have that flexible schedule. So just like you investors do it, do that for one of the reasons of the flexibility. That's why I did it. Yeah. So it's been a good job. I haven't gone rich from it, but it's been a fantastic journey for me.
So those of you see John sitting here, I know John pretty well. The idea of seeing him scrunched into a school bus seat actually makes me laugh. What are you, about 6'3", 6'4"?
I'm 6'3", 230 pounds. So
Yeah,
yeah, it was,
so picture that. That's a good sight. I'd like to see that. Last question. So the last question for all our
and
investors.
Mike, to be
Yeah.
honest with you, I scared the shit out of my daughter too when I was teaching her softball. Those girls got real nervous when I raised my voice. That's for sure.
Yeah. So last question. The question I always ask investors is, what's one mistake that they made, that they learned from, that they, wish they could pass on that advice, or one thing they wish they did differently that they could pass on to other investors. I'm going to ask you a little bit differently. What's the biggest mistake you see investors make in investing that you would say to investors, don't do this?
Well, you know what it is price per square foot. That is something that agents and investors put a lot of thought into and a lot of credence into it. And I will tell you that it's really not something that we take a look at. All right, so much more goes into price per square foot, size of the property, size of the lot size, work that's been done to the house. So it's a little bit what I'd like to do, and I'd like to end the call and give you guys a really good nugget for when you're looking at properties and when you see a difference in square footage. Remember, we're going to be looking at comparable homes. So if you have a 2,000 square foot home that you're looking to invest in, and there's a great comp, but it's 1,600 square feet, and you're scratching your head saying, well, it's 400 square feet. The price per square foot is $300. So that's an additional $120,000. That's not the way to look at it. So I'm going to give you a quick little thing that you can use. I figured it out about 10 years ago after doing this for a long time, but it turns out that it's an actual appraisal theory. So I was happy that I thought about it before even hearing about it. It's called the Ratterman method. And all it is you take your comparable sales and you come up with a price per square foot. And let's say it's $310 and $290 and $315 and $320. All of a sudden you see on a little graph, you see it's about $300 per square foot. Divide that by a third. So divide your price per square foot by a third. In this case, it's $100. Then you can times the 200 square foot difference or the 300 square foot difference by 100 and come up with a logical adjustment for the size. So 1/3 your price per square foot is a very good little nugget for you to remember.
Yeah, that makes a lot of sense, right? Because the house might be larger in square footage doesn't mean it's more usable, or doesn't mean the little bit of size and difference in room size makes a difference to anyone that they're willing to pay that much more. So that's great advice. Well, John, this has been really great. I really appreciate your time, your expertise. Again, everyone, this is John Copulos, Copulos and Associates. Check out his Facebook group, Ask the Appraiser. And thanks for listening. And we will see you next time on Flip Your Life.